Fiscal Policy versus the Monetary Policy by Kaylee Puzo. The fiscal policy is a change in government expenditures and taxations to achieve macroeconomic goals. Changes in the fiscal policy affect the federal government. Typically, the annual budget will be in a deficit or surplus. Here are some definitions. Budget deficit is when government expenditures are greater than tax revenues. Budget surplus is when tax revenues are greater than government expenditures. The Keynesian fiscal policy theory, the level of real GDP is determined by the level of total expenditures. If total expenditures is greater than the ideal, the result will be an inflationary gap. Keynesian fiscal policy continued. If the economy is in a recessionary gap, real GDP is less than the natural real GDP. If the economy is in an inflationary gap, real GDP is greater than natural real GDP to stop it. Total expenditures need to decrease. Stabilizers. Automatic stabilizers are taxes and transfer payments that automatically tend to move the equilibrium real GDP towards natural real GDP. Automatic stabilizers are taxes and transfer payments. There are some problems with the fiscal policy. One problem is there may be a political bias towards expansionary fiscal policy at all times. Another one is crowding out may occur. Crowding out occurs when increased government spending leads to decrease in private spending. More problems with the fiscal policy is that the fiscal policy may be mistimed because of lags. The information lag is government policymakers have access to information about upturns or downturns in the business cycle only after some time has passed. The policy lag enacts a change in fiscal policy tax cuts, a new spending program. The impact lag, once a change in the fiscal policy is enacted, it takes time before new policy has the full effect of the real GDP. And then the last problem with the fiscal policy is that the fiscal policy could be miscalculated. The latter curve indicates that lowering tax rates may increase tax revenues. The monetary policy is when changes in the money supply to achieve macroeconomic goals. The major tool that the federal government can use to try and move the economy towards a natural real GDP is the monetary system. Keynesian monetary theory is when spending drives the economy. The level of total expenditures determines the level of real GDP. Monetary policy can be used to increase or decrease total expenditures in order to increase or decrease the real GDP. Steps in the Keynesian monetary transmission mechanism is an increase in money supply leads to a decrease in interest rate, which leads to the increase in investment, which leads to an increase in total expenditures, which leads to an increase in the real GDP. Financial intermediation. Savers reduce the risk of loss. Savers do not have to evaluate the ability of borrowers to repay a loan. Borrowers do not have to seek out numerous savers in order to borrow a large sum.